Almost everything you've been told about required minimum distributions is designed to scare you, and most of it is aimed at the wrong year. Because here's the truth, your first RMD probably won't hurt. If you've got $1 million, your first one's about $40,000, and the tax on it is, roughly $3,000. That's it? That's the monster. Your 11th year, on the other hand, is a different animal entirely. At that point, the IRS isn't asking for 4% anymore, and the account it's pulling from is bigger than the day you retired, not smaller. In the next 18 minutes, I'm going to show you exactly what an RMD is, exactly how it's calculated, and exactly what the tax bill looks like at $1 million, $2 million, and $3 million. Real numbers on screen. I'm Michael Reese. I'm a certified financial planner and a retirement tax specialist. And this is the conversation that in our office we have more than any other. Unfortunately, it's often 10 years too late to do much about it. So if you're new here, this channel is about one thing. We're trying to keep more money in your pocket and less to the IRS. Hey, we know we've got to give some money to the IRS, but we don't want to give them any more than the law requires. So hit subscribe and the bell so these videos land in your feed. Let's go. Let me tell you about a couple I'll call Tom and Sheila. Tom is 74, Sheila's 73. They've got a couple $1 million in pre-tax retirement accounts, and it's about $80,000 a year in combined Social Security between them because they both waited until 70 to turn it on. Smart people, careful people. Last fall, Tom got a letter from his custodian about required minimum distributions starting next year. So he did what everyone does. He Googled it. He found a definition. He found a calculator. He typed in his balance and the calculator spit out a number. Tom looked at the number. He thought, that's not so bad. I can manage that. And you know what? He was right. For that year anyway. See, here's the problem. Tom asked the question that the internet is built to answer. What is my RMD? That's arithmetic. It's math. Anybody can do that. The question that actually matters, though, the one no calculator on the internet will answer for you is, what does this do to my tax return, not just this year, but every year for the next 25 years, as the percentage you have to withdraw increases, and your balance increases, and when one of you eventually files as a single taxpayer. See, that's not a number, that's a curve. And the curve is the whole story. So today, we're going to do this the right way. I'm going to show you what an RMD actually is, how the math actually works, and how it's actually taxed. And then we're going to run Tom and Sheila's tax return at $1 million, $2 million, $3 million, changing exactly one number, so you can see for yourself where the line is. Start here. Every dollar in a traditional IRA or 401k is money you've never paid tax on. You got a deduction on the way in, and the government let it grow untouched for 30, maybe 40 years. That was never a gift, that was a loan, and the IRS wrote the repayment terms. A required minimum distribution is the repayment schedule. At a certain age, the government says, all right, you've deferred long enough. Now you have to start taking money out of that account, whether you need it or not, whether you want it or not, and you'll pay ordinary income tax on every dollar, forever, until the account is gone or you are. And heads up, it also will affect the dollars you pay on other parts of your income in tax. So when does it all start? And this matters because half the videos on YouTube are going to tell you 73, half will tell you 75. They're both right. It all depends on when you were born. Here's the rule. It's pretty simple. If you were born before 1960, either A, you're going to start at 72, which means you've already started in that scenario, or B, age 73. On the other hand, if you're born January 1, 1960 or later, it's age 75. So look at your birth year, not the internet. If you're 63 today, you were born in, 1962, 1963, depending on when your birthday is. Your RMDs are going to start at 75. That's 12 years of runway. Hold that thought. It's going to matter enormously by the end of this video. 3 quick things that surprise people. 1, Roth IRAs have no required minimum distributions. None. Not for you, not ever. And as of 2024, Roth 401ks don't have them either. That's not a small detail. That's the entire reason the Roth conversion conversation exists. I did a full video on that last week. 2, if you're still working past your RMD age and you don't own 5% or more of the company, you can generally delay RMDs from that employer's plan, your current employer's plan, not your IRAs. The IRAs you still have to pay. 3, this applies to traditional IRAs, rollover IRAs, SEP IRAs, simple IRAs, 401ks, 403bs, 457s. Basically, if you got a deduction going in, it's coming out. Okay, you know what it is and when it starts. Now let's talk about how they decide how much. The formula is genuinely simple. You just take your account balance on December 31st of last year. Divide it by a number that the IRS publishes in something called the Uniform Lifetime Table. That's your RMD, 2 inputs, that is all. At 75, the divisor is 24.6. So $1 million divided by 24.6 is roughly $40,000. Exactly $40,650. That's a whole calculation, about 4%. And 4% sounds fine, doesn't it? 4% is like a normal withdrawal rate. 4% is what every retirement article you've ever read told you to take anyway. So people look at it and they think, well, I was going to spend that money anyway. But here's what they miss. That divisor is not constant. It's based on your life expectancy. And it shrinks every year you're alive, which means the percentage they force you to take out increases every single year. Take a look at this. As you can see, this is not a withdrawal strategy. That's an escalator, and you're standing on it whether you like it or not. Now here's the part that breaks people's brains, and I want you to really sit in with me on this one. Early on, that 4 or 5% is smaller than what your account earns. So if you take the RMD and you pay tax on it, you'll find that oftentimes the balance goes up anyway. You're being forced to pay taxes on an account that's getting bigger while you take money out. I'll show you exactly what that looks like in a few minutes. It's not intuitive and it's not any fun. So that's how much comes out. Now, what does it cost you? Every dollar of a required distribution is ordinary income. It's not capital gains, not qualified dividends, not the friendly rates. It's taxed exactly like a paycheck at the highest rates in the tax code, and it lands on top of everything else you've got coming in. But the tax bracket is only the first bill. There are 3 more, and they don't show up on any calculator. Number 1, Social Security. Most people don't know that their Social Security can be taxed at all, but up to 85% of it becomes taxable income once your other income crosses a threshold. And RMDs are often the thing that pushes you over. So the RMD just doesn't get taxed. It reaches over and drags Social Security into the tax return with it. There's a stretch there where every extra dollar of RMD makes another 85 cents of Social Security taxable, and your real marginal rate is close to double what the bracket chart says. That's what people mean when they say tax torpedo. I'll do a whole video on that in a few weeks. Number 2, Medicare, IRMA. Your Part B and Part D premiums are priced off your income from 2 years ago. RMDs increase your income. And IRMA isn't a slope, it's a cliff. $1 over the line, you pay the full surcharge for the year. Per person. I talked a lot about this in last week's video. And number 3, this is the one nobody wants to talk about. Someday, one of you passes on and the surviving spouse files single. Same RMD, same account, but half the bracket width, half the standard deduction, the taxable on the survivor goes up in the worst year of their lives. I'll show you that number at the end, and you want to be sitting down for that one. Oh yeah, if you live in a state with an income tax, you got to add that on top of everything I just said. 4 rules. They're short, they're expensive. 1, miss an RMD, and the penalty's 25% of what you should have taken. 25%. Hey, it used to be 50, so congratulations, I guess. If you catch it and fix it promptly, it drops to 10. Still, this is the most avoidable tax in the entire tax code, and people still end up paying it every year. 2, the first year trap. Your first RMD technically isn't due until April 1st of the following year. That sounds cool, but it's a trap. Because if you take that first one in the grace period, you're taking your second one in that same calendar year. So now you've got 2 RMDs combined in one tax year, one tax return, one bracket. I've watched people do this. It costs themselves up to 5 figures just to gain 3 months. 3, aggregation. If you have 5 IRAs, you can calculate the RMD in each one. Add them up. You can take the whole thing from any one of them. Fine. But 401ks don't work that way. Each 401k has to be calculated and taken separately from that plan. Get this backwards, you've got a shortfall in one plan and a 25% penalty attached. And number 4, this one's actually good news. If you are charitably inclined, a qualified charitable distribution lets you send money straight from your IRA to a charity. It counts towards your RMD, and it never touches your tax return at all. Not a deduction, an exclusion. It is the cleanest tool in the box, and almost nobody uses it. I'm going to do another video specifically on that in the next few weeks. All right, let's talk numbers. Here's a setup, and I want to be really transparent about it because I'm going to hold everything constant except one thing. We've got Tom and Sheila, both 75, RMDs are running. They're married, filing jointly, $80,000 a year in combined Social Security. No pension, no part-time work, no rental, just Social Security and the IRA. We're trying to keep this simple. We'll use a standard deduction, including the extra deductions that they currently get for being over 65. Those do go away in a couple years, by the way. The only thing I'm going to change is a balance. 1 million, 2 million, and 3 million. Watch what happens. $1 million divided by 24.6. Their RMD is $40,650. Because of that RMD, about $37,000 of their Social Security becomes taxable. Their adjusted gross income is about $78,000. After the standard deduction and the senior deductions, their taxable income is around $30,000. Now, what's their federal tax bill? It's about $3,158 on $120,000 of household cash flow. Now, let me say that plainly because I don't think anybody says it on YouTube. If you have $1 million in an IRA and $80,000 in Social Security, RMDs are not your problem. They're nothing. You're in the 12% bracket. No IRMA, you're fine. At least for now. But hold on to that because things are about to get interesting. Now, let's take a look at 2 million, same couple, same Social Security. All we're going to do is double one number. Instead of $1 million, we now have 2 million. We're going to divide that by 24.6. RMD, $81,300. Now look what happens to Social Security. At $1 million, about $37,000 of it was taxable. At $2 million, $68,000, the full 85%. It's now maxed out. Their RMD went up by $40,000 and it dragged another $31,000 of Social Security onto the tax return with it. $71,000 of new taxable income from a $40,000 increase. Taxable income, about $102,000. Federal tax, just under $12,000. They've crossed into the 22% bracket. So the balance doubled and the tax bill went up about 4 times from $3,100 to $12,000. That is a tax torpedo live. And nobody sends them a letter about it, and the IRS doesn't tell you about it. Okay, now let's look at 3 million. RMD, $122,000. Money they didn't ask for, and they may not even want it. Social Security, that's already fully taxed, so there's no more of that to grab. But now their income is high enough that the senior deduction starts to phase out. AGI, $190,000. Taxable income, about $145,000. Federal tax, roughly $21,400, solidly in the 22% bracket. And about $8,000 away from getting that IRMA letter. Now, everything I showed you was just year one. Here's what nobody shows you. Let's take that $3 million couple and let it run. They're going to take the RMD every year. They pay the tax. The account earns 6%. Let's take a look and see what happens over the next 10 years. Remember, when they're 75, they're forced to take out a little more than $120,000. 4% is their distribution rate on a $3 million IRA. By the time they're 78, their required distributions now up to $142,000. 4.5%. And the account's growing. By the time they're 80, their required distribution almost $159,000. $158,808. Close now to a 5% distribution rate. Now they're 83. $184,000 is the required distribution. Why? Now the percentage is up to about 5.65. They're 85 years old. $200,000 plus of required distribution. Money that they may not want. 6.25% distribution rate. Look at that right-hand column. 10 years. They've taken out over $1.5 million. They've paid tax on every single dollar of it. And the account's bigger than when they started. At 85, the RMD is $203,000. Their tax bill is now around $40,700. They're in the 24% bracket. IRMA is definitely being charged. Call it another $2,500 for the year. Their balance is still $3.2 million. And it keeps going, and the percentage keeps climbing. That's not a retirement plan. That's an annuity that the IRS wrote for itself, and Tom and Sheila, they're the ones paying. Then there's the last column. This is the one that I have to show you, and I'm sorry, but I'd be doing you a disservice if I skipped it. Let's say Tom dies at 84, and now Sheila's 85. Nothing about the money changes. They've got the same $3.2 million, the same $203,000 RMD. That doesn't shrink because he's gone. Now her Social Security drops, but she keeps the larger of the two. She loses the smaller check. Call it $50,000 instead of $80,000. So, less income, but a bigger tax bill. How is that possible? Well, it's because filing single, her brackets are roughly half as wide. Her standard deduction is roughly half. Her senior deduction, that's gone entirely. Her federal tax in that same RMD is about $49,200. $8,500 more than when Tom was alive on $30,000 less income. Her marginal rate has jumped from 24 to 32%. Her Medicare surcharge, which she now pays alone, roughly doubles. Same account, they're both alive, and then we have Sheila alone. The RMD stays the same. Social Security drops. But the overall taxes, they go up. Less money, higher tax. That's a widow's penalty. It's baked into the tax code. There's nothing you can do about it at 85. But there is a great deal you can do about it at 63. So, back to where we started. What are RMDs and how much tax will you actually owe? At $1 million, about $3,000 a year, and you can stop worrying about it. At $2 million, $12,000, and your Social Security got dragged in. At $3 million, $21,000. At 75, $40,000, 85. Almost $50,000 if you're on your own in an account that refuses to shrink. But here's the thing that I actually want you to take away, and it's the reason I made you sit through all that math. If you have $1 million today and you're 63, you don't have the $1 million answer. At 6%, that account is $2 million by the time you're 75. You're not column 1, you're column 2. And if you've got $1.5 million today, you're column 3. The column you're in isn't the balance on your statement today. It's the balance on your December 31st statement before the year in which you turn 75. And the only years you have any control over which column you land in are the ones between now and then. If you're anywhere in that window and you'd like to know which column you're headed for, we always offer a complimentary retirement tax review. Your actual balances, your actual Social Security numbers, your actual timeline, all of your actual income. We'll build the curve. all 25 to 30 years of it. You'll see the number before it's a surprise instead of after. The link to schedule a visit's in the description below. We do keep a limited number of these open each month. Don't miss out, get your numbers, and I'll see you in the next video.